next guest is overweight on fixed income, neutral on equities with minimal cash. With us now is Mike Enriquez, the president of Sun Life Investment Management and Trust Corporation, which manages 410 billion pesos in assets. It's so good to see you, Mike. Welcome to the program.
Thank you, Kathy, and nice to be back here.
Yes, indeed, and to see you in person. What do you make of the Fed minutes?
Well, I think that's quite expected given that there has been a lot of speculation on what the new Trump policies will be, on, especially on tariffs. I think everybody's expecting that it may be inflationary for the U.S. given that Trump has been quite aggressive in the tariff imposition for.
But it appears that the markets now don't care. I mean, the S&P 500 has just hit a record there,
Yes.
so it's a happy day for investors in the U.S.
Yes, so far, yes. I think that's one of the good things about the effect right now, because everyone's still bullish. And right now, fundamentals continue to be strong, and the underlying fundamentals of each of these companies remain to be very solid. That's why I think, in spite of that headwind, I think there is still a lot of bullishness in the market for the U.S.
Now, what about the PBOC? We're waiting for the interest rate decision there. It's the second biggest economy, so people are also watching what they'll do with rates.
Yes, I think as what was mentioned, I think based on the consensus, I think China might hold back on their aggressiveness to cut to support their economy, given that the U.S. has been imposing tariffs. I think they're quite anticipating on what that might be inflationary as well for their economy. So I think all of the central banks are really wary of the effect of these tariffs globally.
I'm keeping tabs, actually, because ever since the Bangko Sentral decided to keep rates on hold, we've seen that the Reserve Bank of Australia made a go for it, the first cut in 5 years. And now we have the PBOC potentially keeping rates steady.
Steady, yeah.
So what are you making out of this? I mean, the kind of reaction we're getting from Asian central banks.
Yeah, I think for the RBA, I think they just cut it since the Philippines has cut last year already. So I think the adjustment in rates was for the BSP is enough for now. But I think for them, they're also weighing on how it'll affect growth, because last year, remember, GDP was a big miss for the Philippines.
Well, which leads us now to the interest rate differentials. Basically, we want to make sure that we're tracking the Fed funds rate. If you were the governor, you'd want to do this. We're at 5.75%, keeping that gap there at the Fed funds rate, 4.5% at the top end.
Yes.
What is the ideal interest rate differential for an investment manager like yourself?
Well, I think you have to look at the historical differential between, for example, the Philippines, where we track closely, and the U.S. Fed funds rate. And any deviation from that, which we're seeing right now, will definitely affect the currency. And, you know, the currency is, if it depreciates so much, then it affects a lot of things. One is inflation. Second is the Philippine equity market, because a lot of our investors are foreign. So any improvements or increases in equity market performance would just be offset by any depreciation in the currency.
But at 58 to the dollar, you happy with that?
Well, I think right now it's a bit stable, but even the governor himself has mentioned that he's not discounting the fact that it might go up to 60. So I think they're watching closely the interest rate differential, as well as how it'll affect growth in the country, because I think everybody's anticipating, and all the economists were disappointed with the hold from the BSP, and that's why the peso immediately reacted, broke 58, it strengthened to 57.
It did. We watched it right in this program, and I do know that the governor himself said it's not really the level, but the pace at which it goes to 60.
Correct.
So which brings us to your portfolio strategy. Very interestingly, you've got an overweight on corporate bonds. For fixed income, but you've got a neutral on equities and minimal for cash.
Yes, we're trying to maximize the cash. We're fully deployed on cash. Mostly, well, the reason for fixed income is really we think that rates on the long term especially will start to go down.
That would be the 10-year?
The 10-year will start to go down as the BSP will continue to cut rates. Our expectation again is they will resume by April. And The other driver for long-term rates is the differential between the 10-year U.S. Treasury and the 10-year government bond yield. So we know that there's some supply happening for Philippines would need to plug the deficit, bit more borrowings. But I think as the 10-year, we expect 10-year U.S. Treasury to go down because there's some risks in the U.S. So there's more demand for risk-free assets. So that might probably bring down a 10-year yield, and that will probably bring down the 10-year government bond yield.
Keep our eyes on the Treasury
Yes.
yields. Never forget that there's the bond market apart from the stock market.
And that is the one that's driving the movement
true.
of equity markets recently.
All right. Well, thank you so much for that
Sure.
guidance, Mike, and good to see you.
Yeah, thank you.
Appreciate the time.
Yes, thank you.
Mike Enriquez of Sun Life Investment Management and Trust Corporation.